Hello, everyone, and welcome to today's Blockworks webinar, Decoding Option Flows, Key Insights and Analysis into Crypto Volatility. Today's episode is made possible by Amberdata. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A function at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand, and all registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks co-founder, Michael Ippolito.
Thanks, Kate. Really appreciate that and love the song choice intro. There's nothing like a little bit of classic rock to get you ready to talk about options and flows. Guys, really excited to kick this webinar off. We have a really interesting topic today. And I want to give a quick shout out before I do the round of intros here and turn it over to Greg. I want to give a quick shout out to this session's sponsor, Amberdata. So I'm sure many of you know Amberdata, but in case you don't, they're the leading provider of digital asset data, market intelligence, and risk analytics. They deliver comprehensive data and insights into blockchain networks, crypto markets, and decentralized finance, empowering financial institutions with data for research, trading, risk, analytics, reporting, and compliance. AD Derivatives platform provides comprehensive spot volume, derivatives, data history, together with a robust set of analytics and tools that allow traders to identify opportunities, manage risk, and build better strategies. We're also going to be walking through a report. This is sort of an abbreviated version of the longer report that Amberdata actually compiled. I highly recommend that you all check it out. We're going to be sending it around at the beginning of this session, and Greg and our fantastic panelists here are going to be walking through actually in a little bit more detail. So to just do a super quick round of intros here, and then I will fade into the mist and hand it over. But today we are going to be hearing from Greg Magadini, who is the Director of Derivatives at Amberdata. We also have Luuk Strijers, who is the Chief Commercial Officer at Deribit, Euan Sinclair, who's an options trader and author, and Fabio Bassani, who's an analyst at Amberdata Derivatives. So without any further ado, Greg, I will turn it over to you.
Cool. Thanks a lot. Well, nice to be here. Hello to everyone. So real quick, we just dropped in the chat a link to our quarterly report so you can get the whole PDF. It's 31 pages. We'll go through a slide deck today, which is just a few pages to highlight some of the key features that we've discovered in our analysis. So Kate, if you wouldn't mind bringing up that slide deck so we can kind of scroll through it as we talk through it. Perfect. So starting off, just kind of a brief overview. We run these quarterly reports every 3 months. We've done a lot of analysis in the past 4 years of data. We've really highlighted the data of option volatility trading on Deribit. Deribit's really the main game in town. We never really see it below 85% of market share. So maybe Luuk, if you could just introduce yourself and, how did you guys capture so much market share and retain it so well? That's a really key insight for some of the vol traders in the space.
Yeah, yes, of course. Thanks, Greg. Yes, we've been around since 2016 when we first started trading. We focused on options since day one. Essentially, when no one cared, not even you, Greg. We were before the curve, ahead of the curve. And I think that head start has given us our position today. So we are dedicated to building the best options platform out there. That means that we do stuff differently than various other peers. If you look at our setup, we're not cloud-based. We have dedicated hardware, which means that we have the fastest available machines, that we have the ability to co-locate clients, cross-connect, and a variety of other network solutions that the cloud simply cannot offer, which makes us faster in data dissemination. We have multicast, a service that no one else has in the space as well, which is faster market data than the typical solutions. We have market maker protection. We have, I think, better portfolio margin than any other. And we keep investing essentially every dollar we make into making the platform better. So we're looking at latencies. We're looking at linear options, cross-collateral, and a bunch of other features that we hopefully discuss later. But we are 100% committed to options, which is unlike other platforms that have options as a side product. So yes, we had the head start simply because we believed in the options potential since day one, but we also will always remain focused on the options product, not as a byproduct, but as the primary product, which I think is what clients like. Besides that, we have a good reputation, I think. In order to lose market share, in a way, you also have to do something really bad. Option flow is sticky. So we have options up until a year out. Clients don't easily move positions. So if you keep working on your relationships and the service you provide, I think there's not much of a reason for clients to leave. The way we do this, for example, is, as well as via custody. So we have onboarded what we call custody of choice. So we have Copper and Kobo. We're beta testing Fireblocks, and we're in discussions with other platforms as well. Where after FTX, the confidence and the trust in platforms has been reduced. So in order to safeguard client positions, we allow them to custodize their assets elsewhere. So we only settle the P&L on a daily basis, but not keep custody of the primary assets, which has been working out well for some of our very large clients, but it's available for any client, and stuff that like that sets us apart. So we really believe in the institutional offering, allowing the retail base or sophisticated traders to leverage of the same institutional grade solution that we offer today.
Yeah, fantastic. Well, thanks, Luuk. So just kind of jumping into the data. So we have, the privilege of a really good team of analysts, Euan Sinclair, Tony Stewart, Fabio Bassani, Samneet Chapal of Ledger Prime, and myself. So Kate, if you don't mind scrolling down a little bit, we'll just jump into the data here. So scroll down one more. So the first thing that we've really seen this year, so we did a report earlier in the year in January that we released, and we looked at the 2022 data. One of the things that we're looking at is just a spot vol regime. So you can see the scatter plot on the left-hand side here, showing us in 2022 that the spot vol regime for both Bitcoin and ETH was, distinctly negative, really tight relationships, and the relationships mirrored each other really nicely. 2023 was a little bit different. So we could see a positive spot vol correlation for Bitcoin, slightly positive, and a slightly negative spot vol relationship for ETH. Bitcoin really outperformed during the SVB banking crisis and kind of held on to that outperformance. And then for the exception of maybe the ETH Shanghai upgrade, ETH has been pretty quiet year to date. So, this is kind of an interesting phenomenon. Euan, I'm wondering if you could just kind of talk about sort of what you see here in terms of spot vol divergence and two highly correlated assets.
Yeah, thanks, Greg. I think if you look at 2022, these are very typical spot vol relationships. They could be for almost any product, that very typical negative downward slope. And as you said, it's very similar between the two products. Whereas if you look at 2023, really that's almost a zero correlation, but it's interesting that they are definitely pointing in different directions, right? I think this is indicative. It's not just numbers, right? There's stuff going on behind the numbers. And I think we're seeing a maturing of the market where Bitcoin is now operating legitimately as a currency. It's moving based on macro things. It's moving relative to the dollar. It's moving relative to the carry rates on Bitcoin. It's sort of now, although it's difficult to spend, it is behaving in volatility terms like you would expect a currency to. Whereas ETH is now looking to me like more of a tech stock, which sort of makes sense, right? You can do technical things on the Ethereum chain that you can't do on blockchain, on the BTC chain. And to me, this is interesting going forward. I think in the past, there were lots of easy trades you could do between ETH and Bitcoin volatility. I think going forward, it's going to be, you'll be trading Bitcoin in a sort of in a currency world, and you'll be trading Ethereum in a tech world. So I think going forward, you wouldn't trade these things against each other necessarily, just as you wouldn't trade two stocks against each other just because they were domiciled in the same country. So I think this is going to bring up a whole bunch of different opportunities, right? I mean, right now we only have the two volatility products we can go against each other, but this is going to really open up the space, I think, as it matures.
Yeah, interesting. Kate, if you don't mind scrolling down a little bit to the next two charts. Yep, this chart, the beta, and we'll go to the next one right after. Fabio, if you can just chat about the beta, kind of what you've been seeing.
Yeah, sure. Very interesting what Euan just said, because we also noticed some divergence activity in the returns of BTC and comparing to it. In this chart, we are displaying the rolling return, 30-day returns of beta. So meaning that is expressing the ETH returns in BTC terms. So for example, beta of 1, just to give context, beta of 1, meaning that if 1 point of returns in BTC is 1 point on ETH, under 1 point on BTC is less than 1 point in ETH returns, and also for above 1. So this is the recent history. Since January 2021, we never saw a so persistent lower than 1 beta correlation between the two assets, and this is an increasing effect since the Silicon Valley Bank weekend, where we saw that beside become a currency, I think that BTC as an asset is seen to market participant like the real no counterparty risk asset, the only one that has this typical function. So we have some overperformance of BTC on the upside movement compared to it, that is quite unusual. If we scroll down to the next chart, we could see another way to depict the same concept. Basically, this is the realized volatility of the two, BTC and ETH, since 2021. And we saw that before March, April 2023, we never saw BTC realized volatility higher than ETH. It's quite clear if you look at the ratio under the main charts, where we have the positive ratio, meaning that BTC realized more than ETH only in March 2023. And is this fact with the market participant looking at different way of BTC, and the fact that this type of movement is now stable because it's not related to higher beta volatility, but we have a stable under 1 beta. I think we now enter in a new regime where BTC could outperform ETH. And the last point, very interesting, we analyzed the different spectrum of spot movement and the beta correlation between the two assets. On the upside movement, we have under 1 beta, meaning that BTC outperform ETH, but with the downside movement that we recently saw in March, also in June, we saw that ETH has higher than 1 beta correlation. So this is could structure interesting trading ideas, is quite a relative volatility trading, but something we notice is interesting to highlight it.
Yeah, the asymmetry between an up move and a down move, the beta is different.
Exactly.
So this is kind of like some of the things that we're seeing in the realized space. If Kate, if you could go to the next slide. So now really what's interesting about the options market is really looking at what people are doing in terms of trading options. So one of the things that we spent a lot of time figuring out, and if you could say on this slide, this is perfect. We spent a lot of time figuring out the direction of each trade. So obviously Deribit tags, we'll do a tag of the last aggressor on a buy or to sell. But there's a lot of edge cases where what we're trying to do is figure out the aggressor that's, if we assume that market makers are passive, we want to figure out who's the aggressor that's not the market maker versus maybe something that's tagged where the market maker is aggressive. So you can think of a limit order in the options book, spot moves around, market makers refresh quotes, and they hit a retail limit order. Well, now it looks like the market maker is the aggressor. So Fabio, if you don't mind just kind of chatting about sort of the high level direction analysis we've done. We've devised this with the help of Euan and Tony, myself and Fabio. And Fabio's the mastermind of this. So Fabio,
thank you. Yeah, sure. When we started in early later 2021 reality, we wanted to try to depict a more reliable flows we are seeing in the options market, because we noticed that sometimes centralized engine on Deribit, other exchange, didn't tag in a reliable way the more nuanced trade we saw in the market. Just for example, for example, an initiator of a trade is a premise. We want to look at the initiator of trade. So who at first expressed the view of initiate a trade. This is very important quotes to keep in mind, because we have some assumption, of course, Greg just said about them. We assume that the taker is a trader and the maker is, of course, a dealer, that usually the taker wouldn't delta hedge while the dealers will hedge, but maybe we can talk later with the gamma profile and other methodology. But with the GVOL, what we call them, because we work in Genesis Volatility, now Amberdata derivatives, it's called a GVOL direction, and is based mainly analyzing the main component trading of flow we saw in the market. For example, the first categorization is between blocks trades and on-screen trades. And in blocks trades, we divide also the flows in single leg trades and multiple leg trades. This is a very useful categorization, classification, because it permits us to work on different rules for each type of trades, because we know that some nuanced aspect of the trades is different between the different components of the trader. So after working with Greg, Euan, Tony, that is Tony Stewart, Pelion Cup on Twitter, is with valuable feedback, we arrived to define almost 30 heuristics. Heuristic is just to say a probability rules, because of course we don't have the certainty, but we assign to each rules a sort of a percentage of probability to be correct. So we define some sort of property system where we arrive to define also a weighted index for each rules, just to summarize everything in one single component and tag each trade to a sell or a buy trade. And this is possible because we have the quote of the order book at millisecond level. So what we do currently, just to not to give it too much details, but basically arrive at trades, we compare the trades with the status of the order book on the previous millisecond and the state of the order book after the trades, and we compare in a holistic view how the trade is compared in the order book previously and post the trade. So with this in mind, we built a strong, in my opinion, matrix that depicts correctly who initiated a trade. Just to give you numbers, in Q2, we calculated 32% of change direction compared to the engine. So meaning that our direction differs from the direction we are seeing on the API of, for example, on Deribit, on 32% in volume. This is quite low because on that volume, you have also other impacts, because afterwards we develop other tools like the gamma levels and gamma profile and everything. But just to give a short idea, this is the main core idea that is permit us to build us a more reliable view about the trading flow we see in the options market.
Yeah, assuming that market makers are passive, exactly.
Yeah, exactly.
Euan, do you want to jump into that kind of from a TradFi perspective?
Yeah, to me, one of the interesting things about this, and one of the interesting things about a lot of Bitcoin stuff, is that with Bitcoin, although the technology is the future, a lot of the trading methodologies are actually the past. You know, you look to see what market makers were doing 30 years ago, and that's what's happening now. And there's a reason that stuff's good. It's because it works. And this idea of market making and positioning having an impact on the underlying through a feedback effect from their hedging goes way back to the 70s, when there were, 5 guys standing in an options pit, and they would literally keep track of all the trades they did, all the trades the other market makers did, and they had a very good, clear idea of what the customers were doing. People seem to have become very excited about this as a new idea, maybe 3 or 4 years ago. And the problem a lot of people had was that it's much, much harder now to get a signal, because there are a lot more trades and you're not seeing every single one. And the difference between a closing trade and an opening trade and a trade after the market's gone down a lot or the market's sitting there, these are where all these heuristics come in. It's very difficult now to do this. And I think, like Fabio said, we've been working on this for 2 years now. Like, a lot of people have these gamma profile models, but if you just do it based on, one idea, like market makers always do this, it's so simplistic, it's not really going to give you anything. So to me, this is great because it's an evolution of an idea that we know works. And you have to do it very carefully, and we have. So you kind of get rewarded for taking care of all the details. And this is the basis for not just seeing what the market makers might do in the options market, but a lot of the sort of levels that underlying traders like to look at can be, you can ascertain where they're likely to be through this kind of analysis. Because, the market wants to go to places where there's a lot of gamma, because that's where the market makers are pushing it, from their hedging. So knowing this, I mean, for me, trading 0 DTE options without this now, you're at a significant disadvantage. And as far as I know, I don't want to criticize everyone else in the world, but I know what we've done, and it's pretty good.
Awesome. Thank you, Euan. Kate, if you don't mind going to the next slide. So one of the interesting things that we saw this quarter is kind of like a divergence between Bitcoin and ETH. So if we're looking at the Bitcoin tagged flow, we can really see here, starting sort of in April, but really second half of June, a lot of buying activity around 27K level, some option buying activity around 31K, 32K. And you can see, like, on this flow chart, it's almost all blue. So there's a lot, Bitcoin is in a way an under-owned asset, and there's a lot of buying flows. Kate, if you can go to the next slide. And then on Ethereum, we had the Shanghai upgrade, which basically allowed people to withdraw some Beacon ETH from staking. And so not only this red line shows the Shanghai upgrade, but the ability to sort of take out your ETH if you wanted to, enabled people or gave people the confidence to stake more ETH. And so ETH sort of became this yielding asset where you can unyield if you want to. And so it became sort of a yield machine. And what we saw is people would sell a lot of covered calls against ETH, or we assume it's covered calls, but we saw a lot of call selling in ETH. So there's a huge supply of volatility paper. And so we think people were staking ETH, earning yield, and selling covered call for enhanced yield. And then, Kate, if you can go to the next slide. And so this brought us to the June expiration, which was a massive expiration on Deribit. And we could see the gamma profiles between Bitcoin here on top and Ethereum here on the bottom, how divergent they are. And that's really a function of those flows. And obviously, these are our estimates on our gamma profiles, but we think they're pretty accurate. And Luuk, maybe you could just talk about that expiration. It was a big expiration for you guys.
Yeah, a massive one. So it was one of the biggest ones ever. Typically, the quarterly ones are bigger. So this one, I think it has a few storylines being mixed together. So on the BTC side, we've seen a lot of new inflow also started from March. So your charts, I think, started from April, but it started from our perspective in March already. After the banking crisis and the problems there, we saw a lot of inflow. A bunch of that expired in March already, but a lot of it remained open until June now as well. I think looking at the massive amount of short gamma here, we expected action. I think it's a really cool tool, by the way, but it didn't really happen that much. We saw a bit of increased implied and realized volatility, but it didn't bring the action some people were anticipating. It could have worked out differently. On the ETH side, you see the opposite. You see the long gamma. I think a lot of it is called, what a lot of people on Twitter write about as well, is the ETH overwriter. So there's a big ETH vol whale selling volatility, and a bunch of that expired in June, and there was perhaps hopes that volatility would revive after the expiry, but it didn't really happen. The crazy thing is that ETH is still approximately the same levels, sometimes below or above BTC, which is kind of strange, which is partially caused by this seller that remains active. So it has been in numbers a very large expiry, 6 to 7 billion notional, which typically results in increased activity, which happened that week as well. We saw a vol climb slightly, but there's always somewhat action, so volumes were higher. It's been a good week for us as a platform, but it didn't bring the action some were hoping for. So great tools and great potential, but not that much realized.
Yeah, right. The options market is still relatively small compared to the spot market, but it's a good sentiment and a gauge on sort of how people are positioned. But it might not necessarily translate into spot movement. But hopefully in the future, I think it will. Can we?
It definitely will. It definitely will. So and it could have happened. So I think your tools give good insights in the strikes where larger OI is concentrated, and I think that's what's key. So some expiries are quite dull because there's simply less open interest and less potential action, but sometimes there's quite a lot of outstanding, which could drive to like pinning to a certain strike of market maker positioning. So it's definitely good to keep monitoring.
Yeah, absolutely. So Deribit launched some devol futures, so that's really exciting.
One quick second there, Greg, just before you get into that, I just want to remind audience members that we're doing a Q&A here, and we're going to start in 15 minutes. We've already seen questions piling in. We've got a bunch of smart panelists on here, and we're going to be going in chronological order, just trying to get to as many questions as we possibly can. So make sure to get your questions in now. Just wanted to remind everyone. Sorry, Greg.
Absolutely. No problem. Cool. So if we scroll down a little bit here, so here's the devol index for Bitcoin and ETH. So you can think of devol as basically the VIX of Bitcoin and the VIX of ETH. And for those who don't know, that's really a 30 days to maturity target. And it's a holistic view sort of across strikes. So it incorporates not just at the money vol, but the wing vol as well. And so if we look at devol between ETH and Bitcoin, there's kind of two things that stick out. One is really what looks like a structural shift lower in vol over time. And then the other one is the convergence between Bitcoin and ETH vol. And if we scroll to the next chart here, so one of the things that we've done is, implied volatility is really the best, is kind of the options estimate of the future realized volatility. So what we've done is we've lined up realized and implied to calculate the historical variance risk premium. And so what we can see here on the histogram on the lower half is that typically options are overpriced. Buying vol in crypto is kind of a hard game to win. And if you're selling vol, there's a lot of positive carry built into that. And if you're wrong selling vol, you're not only are you rarely wrong, but it's wrong by a small margin, for the exception of May 2021 in this calculation window. So that's something that's really interesting. Euan, I know you're someone who's an expert on the variance risk premium. Maybe you could talk about it from a TradFi perspective as well, which we have another chart for that.
Yeah, it's no mystery there's a variance premium in most things, right? It's the Black-Scholes model and every option pricing model lives in the risk neutral world because you can hedge away the risk of the underlying. And if it's not, you've got an arbitrage. So that's a fair value without a doubt. The problem is the real world, we all have different risk tolerances. And I know options are good. I want to own options. So I'm not going to sell them to you for what we both think is fair value. So the risk premium, the variance premium, is a perfectly sensible thing. And it is in most products most of the time. I mean, you can see right now, it's not particularly high. You might even argue it's negative, although there are lots of different measurements of the realized volatility. So take that for what it is. But the thing to me that stands out most in the crypto world is, well, in the index space, the average S&P risk volatility premium for a 30-day option is about 4%. It's about 4 vol points. So, you know, the average implied is about 18, average realized is about 14. If you look at Bitcoin, I'm not sure what its average is, but there are plenty of times when it's like 30 vol points. There is a colossal, we're not talking a little bit, we're talking a colossal risk premium. So it's no surprise to me that people are doing covered calls. That's a very sensible way to harvest this. You're making a little portfolio of being long ETH and collecting the variance premium. On the other hand, as a trader, if you know someone's doing something, well, that gives you a chance to set up to take the other side. You can lean on that order flow. So I think there are a lot of things setting up here. It's the size of the premium is the thing that stands out to me. And it's always interesting, whenever the risk premium becomes low, you'll find people saying, well, the world's changed, it's going to stay there. Well, maybe, but it's been around for 100 years. I think we need more than a couple of weeks before I'd bet that it's gone away.
Yeah, interesting. Kate, if you can go to the next slide real quick. Here's just kind of a comparison. This is going to be sort of the SPX variance risk premium. And so you can see how much more shallow it is, both to the upside and the downside. And then we'll go to the next slide here. And so here's a chart that we've devised using the DVOL. So what we've done here is we take the DVOL index and then we divide it by at the money 30-day vol. And this gives us a ratio of DVOL versus at the money vol. And this is kind of a way to isolate the curvature of the wings. So you can see the upper red line, that's the upper 90th percentile. And then the lower blue lines, the lower 10th percentile. And so most of the time we're living in this white space. And so this sets up some really nice stuff, especially now that we have DVOL futures, things like, you know, trading a 30-day straddle versus, you know, short a DVOL future, you're long the straddle, short the future. Vega weighted, so you can isolate the Vega component. Obviously, there's some rebalancing complexities there and some path dependency, but this is a type of chart that you could use that trade to trade this chart essentially. So really excited about sort of the adoption of DVOL futures. Euan, maybe you could talk about, you know, VIX futures. In your experience, you know, what did you notice on that adoption front?
It was really slow. I mean, we can look back now and say, well, VIX futures have been around forever. They're massively liquid. There's all these ETPs on them. But that really wasn't the case, right? The VIX was listed, well, the new VIX was listed in 1990, right? VIX futures weren't listed until 2004. And they had no volume until the great financial crisis, you know, the 2008, 2009. So given the way everything in the crypto space is accelerated, I think even then we sort of have to give these things a chance to sort of filter through. It'll take a bit of time, but the next time there's something crazy going on in the vol space, these things, I guarantee they'll pick up at that point. It's difficult to sort of convince someone they need to hedge their volatility exposure when vol's so low. You know, but when the implied vol goes back to 70, yeah, we're going to see volume pick up in these.
Yeah. One of the things I think will help a lot is sort of the cross margin potential. Luuk, can you talk about plans of cross margin for Deribit?
Yeah, sure. Let me get back to the devol thing as well. So because I fully agree with you in that we don't see the volumes yet, but it doesn't mean that the product is not a great product. I think we launched the index at first as a gauge for the market, so to have clients immediately see where we are, how's the market assess risk at the moment and volatility, and we launched, I think 6 or 9 months later, we launched the futures, and we're still in like the very early stages. So we only have BTC, and we're launching ETH later. But it would be great if vol picks up, so that we can actually see the benefits of trading these products instead of the dull markets that we're seeing now. In terms of cross collateral, we're releasing them later this year, end of summer, in a few steps. So first of all, we're launching linear options, and we will launch margining within the USDC space. So it's altcoin options, priced and margined in USDC, and then there will be offset with the various positions of these different altcoins. So that's step one. Step two will be cross collateral, like full cross collateral within the currencies. So you can use your BTC to trade ETH derivatives and vice versa, bringing a lot more capital efficiency and reduction of the capital requirements versus today. Then step three will be adding the altcoin underlyings. So for example, if we would add XRP, we would add XRP in the cross collateral pool as well, enabling clients to do proper covered call selling, that kind of stuff. And then we're going to launch a few other coins for the cross collateral pool, like USDT. So our products use USDC, but that doesn't mean that we limit the collateral to USDC only. We will also add other pairs, for example, USDT. So that really complements the full space, and that's what our clients are pushing for. So it's a big change. It's a technical, complex change. So we are testing all of this stuff, and it will gradually be made available in our test environment. So coming soon. So it's August, September, October, a gradual rollout of all of this.
Yeah, it's very exciting. Cool.
It is.
So that's what we have. Happy to answer some questions.
Yeah, I can facilitate here. I'm looking at the list. Just to go first, and I'll just open this up to whoever wants to answer. But the first one was about liquidity on the devol contract. So it's actually more of a business building question, but just what is the plan to sort of increase and continue to build liquidity on these contracts?
Yeah, so the plan is we're very committed to building this further. So we are open to potential incentives, fee waivers, that kind of stuff, but we're awaiting the right momentum. So if whatever we do at this moment, we don't think that will generate more volumes or more interest, simply because the real benefits of the products only become visible if vol changes. So you need a slightly more active market. Euan was saying 70. When I joined Deribit in 19, we were looking at average levels of over 100. We're looking at 40 now. It's simply not sufficient to activate like a proper marketing campaign. So yes, we will do it. Yes, it's coming, but no, we can't commit to timing and exactly what we will be doing in the absence of a proper trading environment. And I can answer the second question as well. I see whether the direction of the trades is a bug or not. It's not. It's simply definition. So if the spread is like this and someone enters a slightly higher bid and the market maker decides to hit this bid, who is the initiator? The system says this is a resting order by the let's say the retail client, and the market maker initiates it by hitting it. So the system says the way it's executed. The way Amberdata looks at it is from a different perspective. He's saying, look, the market maker might be hitting it, but the initiator was the client putting the order there in the first case. So that should be seen as the initiator, and not the market maker hitting the bid. And so for us, it's working exactly how it's planned, but it's simply definition, different scope of analyzing the trade. Who's the initiator?
Gotcha. Next question here. I'm going to slightly paraphrase, and guys, I'm going to ask you to dust off your crystal balls here. This is the question that everyone always wants to know, but sort of a two-part question of, when do you see outside of just volatility, sort of spot, highs going back to their all-time highs, and then there's sort of a relative question of the performance of Bitcoin versus alts. So maybe we can talk about that within the context of Bitcoin dominance, which saw a pretty drastic run up earlier this year. So how do you kind of how do you feel about the continuing trend of Bitcoin dominance? And then when do you sort of, without making explicit price predictions here, but just like when do you start to see that really take off again?
Yeah, on the question of Bitcoin dominance, this is a forever debate between Fabio and Greg. I'm of the opinion that when we have bull markets, altcoins outperform. I think if we go back to those relationships of a traditional bull market, that's when really ETH will catch up and start outperforming again. And the tech play in ETH to me is something that's always been interesting. And I think Fabio has a different opinion. Don't want to speak for him. As far as price predictions, it's kind of a hard one. I'm just going to skip that portion of it.
Yeah, sure. Basically, divergent opinion, but it's more related to more of the projects that are not so legit out there. So and also how the market dominance is calculated is a little bit misleading in my opinion. Supply is not always calculated in a proper way, but this is another topic for maybe another type of task. And in my opinion, in 2023, for what we've seen so far, I think the BTC market dominance will continue to outperform altcoins. So when increasing share of the total market. And for the reason I said before, I think that the market, for the first time in the history of BTC, is starting to look at like an asset as no counterparty risk. And in the world we're living with all the macro fears, risk, and so on, and I think it's a good place and time to have some allocation in BTC. That's my personal view.
I kind of think the question might be ill-posed. I think it's kind of like asking, will the dollar outperform Google? I think we're looking at totally different market segments going forward. And I think the altcoins are probably going to fragment into the equivalent of penny stocks and the equivalent of NASDAQ. I think a lot of this is just the market sort of maturing and people beginning to sort out the legit projects from the, fraudulent or very, very hopeful projects.
One more sort of follow-on question, and I've got a follow-up question here for you as well, Euan, specifically directed at you. But is Bitcoin dominance at all, specifically these sorts of runs, is there any sort of significance as a cyclical factor in terms of timing? So, for instance, Bitcoin dominance tends to run up starting at the beginning of bull markets as Bitcoin tends to lead, and then people rotate into other more speculative high-risk assets like altcoin. So basically the question is, do any of you use sort of a run-up in Bitcoin dominance as any sort of cyclical indicator? Luuk, you look like you're going to say something.
No, I think what the market this year has been a lot about regulation, and I think all this dominance is driven by regulation and not so much about belief in one coin or another. Bitcoin dominance has grown a lot since March, simply because it was seen as a potential hedge for the banking system, and that was the driver. Now that story has calmed down a bit, but there's still a lot of regulatory news. Are you security or are you not? Which is driving activity, and the consequence will be dominance goes up or down, but I don't think it's something we should all over assess in terms of relevance. It's those macro drivers that determine the heading of the market, I think, at least these days.
Great. Euan, this was a question specifically directed at you, and you actually started to answer it a little bit with that comparison between Google and the dollar. But you said at the opening of the webinar that eventually Bitcoin and especially Ethereum, but let's assume other alts as well, will diverge with Bitcoin sort of trading more as a monetary asset and ETH trading more as like a NASDAQ or technology sort of asset. Do you have any thoughts on the timeline of when that divergence occurs?
Not really. I mean, to be fair, that was a wildly speculative guess based on just sort of feelings rather than any data. And because when something's never happened before, it's pretty hard to put hard numbers on it. So that's just sort of the way, looking at the skews and the flows, that sort of looks to me like where we're going. But there's a lot of uncertainty in that. I wouldn't want to put a number on it.
Roger. Next question, actually, we focused primarily on options here, but this question actually is about sort of other derivatives in the crypto space. So futures and perps have been very popular options for derivatives in crypto, with options being relatively lower volume in comparison. Open question to the three of you is, first of all, why is that the case? And do you see that change in the future?
Yeah, I think the learning curve for options is a lot greater. So just kind of real brief background, like I've been trading options for about 15 years and getting proprietary trading jobs and stuff like that. Knowing options really well has always sort of been an edge because it's just a smaller pool of players. So I think really what we're going to see is we're going to see people who trade options in traditional finance begin to trade options more and more in crypto. It won't be crypto natives learning how to trade options really fast and becoming the main players of the option trading segment. I don't know if anyone else has a different opinion.
So I think so we're trying to activate a lot of what we call sophisticated traders, people that are potentially interested in trading options and explaining them the benefits, etc. It is proven very hard. That's also what we're seeing in other platforms. So we still have like 85, 90% market share, something like that, open interest or volumes. But if you look at our peers, they are different beasts than us. They have, let's say, Binance has 100 million plus clients. If even Binance can't activate these people, it's difficult. They have the full database. But the big difference with, let's say, US markets, where options activity is massive, is that the perps don't exist. So everyone is always looking at, let's say, spot in the US, and options volume is higher than spot, and the crypto space will go there as well. I don't believe that. We're here. We won't go here. We will go here. I truly believe that we will see rapid expansion, but I don't think it will ever be as big as the US market, simply because the alternative doesn't exist in the US. The US investors don't have the perpetual, and the crypto space, 100 million people have, or a few 100 million people have access to the perpetuals and will trade them as an easy way of leverage. And that argument is simply less powerful in the option space for us versus the US market. So we will see a lot of increase in awareness and volatility and all those positioning that option strategies will enable you to do, which is completely impossible with the perpetual, liquidation protection and that kind of stuff. So we will see a big uplift the more mature the product becomes, but it will never be as big as the US segment.
I actually have one follow-up question, and then there's a question aimed at Luuk, but I'll open it up to the panelists about decentralized options. But the other question that, just to follow on there, Luuk, in addition to sort of the sophistication of the average crypto investor, does the fragmentation of liquidity across different expiries have anything to do with it as well, or is that sort of semantics and that doesn't matter as soon as you have more volume and sophisticated investors?
In if you log into our system and you see all the expiries and you see the puts and the calls and you see the gammas, vegas and all that stuff, if you are like Greg, you fall in love and you think it's amazing and this is the best thing ever. If you are an average retail investor, you're completely overwhelmed, and the more choice you have, of course, that reduces the likelihood of you trading if you're not properly educated. If you then spread out across multiple markets, centralized, and one of the questions is decentralized. So of course, it gets more and more complex. What is the difference between a centralized option and a decentralized option? Can you portfolio margin properly decentralized options, etc.? It's very complex. So my view is we will try to educate people. We will try to make them aware. We will try to make our UI simpler, so we can skip out perhaps on the Greeks. We can make your positions tables simpler. That's up to us. But in the end, it will remain a complex product. Whether centralized or decentralized is more interesting. Of course, I'm slightly biased representing a centralized exchange, but I think our client base is predominantly institutional, so they're very cautious of trading on decentralized platforms if they don't know who they're trading against. So over time, that's why we're getting regulated at the moment. The requirements on us as a platform to get audited financials, regulatory status, ISO certifications, SOC 2, all that stuff only increases because our institutional base wants to be sure they're dealing with a high quality platform. All of those certifications will be virtually impossible on a decentralized platform. So I think, yes, you can automate it up to a certain way, but you won't get the same level of portfolio margin, KYC, and diligence that centralized exchanges will offer. So yes, I believe in decentralized solutions, but I don't think it will ever match the centralized size.
Euan, Greg, Fabio, any other comments on decentralized options before we move on?
Yeah, go ahead, Euan.
I was just about to say, I don't really think they are in general helping the adoption of options. It's like a lot of them aren't prepared to just offer like a vanilla call and put. There's always some crazy wrinkle on top of it that makes, I mean, Greg and I have been around a while. Tony's been around forever. And we're looking at it like, what does this really mean? So I don't really ever see them gaining a huge amount of traction until they sort of simplify things dramatically. I mean, we've seen from Luuk, ordinary options are complicated enough.
On my side, I think when I compare like Uniswap versus just a traditional exchange, the big innovation of Uniswap is sort of like this AMM LP model. I think you can either replicate a CeFi experience on DeFi, or you can take the Uniswap experience and apply it to options. I think replicating CeFi on DeFi, it's a hard game to win because the technology is just not going to be as good on chain. I think if you do a novel approach, something truly innovative, like an AMM for DeFi options that's priced intelligently, it can't just be like a constant product thing. To me, that is a source of innovation. And what was really interesting for Uniswap is it allowed anyone to like list tokens without needing sort of like Coinbase to approve your token and list it on their exchange. Anyone could list a token pair. And so if you have like a smart AMM model that protects LPs accurately, or maybe biases towards LPs, but you could start sticking any options in there, any altcoins in there and have optionality come on chain, that to me solves a pain point. And I think the ability to have an AMM just always be online and willing to trade options, obviously there's a liquidity pool sort of constraint. Again, that's sort of a novel and an innovative approach. And to me, the winner of the DeFi options game is going to have something that doesn't look like CeFi necessarily from the market maker's perspective. Because otherwise, the CeFi experience on DeFi still has the same pain points of needing market makers. I remember when Deribit launched Solana, you guys were really careful. You had a really, well thought out plan. You moved very, very, very slowly to do that and do it accurately. If you're going to try to do that on DeFi, it's going to be even more complex. So to me, it has to look different.
And that having an AMM for options, that is in no way an easy thing. That's, I agree. If that happened, that would really allow this space to expand. And you've got a chicken and egg thing, right? Between customers don't want to trade unless there's liquidity, but market makers don't want to trade unless there's customers. So that would be a major breakthrough, but it's not an easy problem to solve.
Mm-hmm.
I think we've got time
the portfolio margining. So if you want to buy one call option that expires whatever sometime from now because you think Bitcoin is going to be worth $1 million, that simplicity is fine. But if you have an advanced inventory of all different expires, long, shorts, it's going to be very tricky to capital efficiently do all of that on DeFi.
Yeah.
And a lot of people are thinking and talking about potential solutions, but thus far there hasn't been any.
Yep, I agree with you, Luuk. That's the portfolio margin. That's impossible. Yep.
Yeah, but I think it's a deal breaker. If you can't fix portfolio margin plus KYC, it will be a tiny retail solution.
Yeah, guys, we've got time for. Oh, sorry, Greg.
Oh, I was just going to say, yeah, that's why I think the DeFi option solution has to be an innovative approach. It can't be the CeFi experience on chain.
Yeah, we've got time for just one more question here, and. So the question is there any interest or demand among institutions for structured products using derivatives?
I can take that one. We have a lot of demand. So that's new platforms coming out, wanting to use our option shelf for their structured product offering. So it's not, most likely, in my view, not going to be the exchange offering those. It's other platforms using our options as building blocks for their own solutions. I think if you look at Asia, Switzerland, and the US as well, the platforms out there that build like innovative stuff with barriers and all kinds of stuff that a typical option doesn't have, capital protection. I think a lot of that stuff is coming using options as building blocks.
Okay. I don't know if Greg or Fabio or Euan, you have any thoughts on that, or I think we can wrap it there, guys. I just want to say this was a fascinating conversation, and big thanks to all of our guests here, and a special thanks to Amberdata for making this possible. I kind of gave an overview of what Amberdata does at the beginning. This is a company that we've known for a very long time, and I really appreciate you sponsoring and making the webinar possible. And I just want to remind listeners again that if you want access to Amberdata's quarterly report, which I highly recommend that you read in detail, we will be sending that along and linking it in the email after this show. And you can, I'm sure, reach out and I'm sure talk to them, and they'd be interested to hear from you. So Greg, Fabio, Euan, Luuk, this has been a ton of fun. Thank you all so much for doing this.
Absolutely.
You're welcome.
Great.
Thank you.
Thank you.
Cheers, guys.